Hey guys, my name is Ernest. I'll be your host for this video. Please, if you have a chance to watch the other video, take a moment to watch those videos. They're really helpful and they'll help you out, okay? If you're not a member yet, go ahead, get access to the premium content. Really appreciate that. And let's move forward. Today, we're going to be talking about the unique aspect of insurance contract, okay? So we're gonna teach you about that. So when we come about the unique aspect of insurance contract, the first thing we're gonna talk about is what we call contract of adhesion. Some people say adhesion, adhesion, whatever how you call it, okay? Adhesion contract. So the contract is prepared by one party and accepted or rejected by the other. So when an insurance contract, let's say that if this was an insurance contract, okay, let's say this is the contract, this paper right here. So it's an adhesion contract, meaning that it's either I accept it or I reject it, no matter how it is. I cannot add to the contract. I cannot take things out. Okay? So it's prepared by one party. So only one party prepared this document, which is the insurance company prepared the contract, not the policy owner or the insured. So a take it or leave it basis. What does that mean? Either you accept it or you reject it. So either you take it or you leave it. All right, that's an adhesion contract. The contract that offered by the insurer, which is the insurance company, with no negotiation. So that's when you cannot negotiate the contract. No alteration can be done to the contract after the insurer issue the contract. Any ambiguities or errors, mistake or doubt, thing that's superstitious about that contract, will be treated in favor of the insured. So any mistake, you're gonna get treated on the insured or the policy owner favor. So insurance is an adhesion contract, take it or leave it basis. Insurance contract, adhesion contract. So either you accept it or reject it. So hopefully you get that so you don't confuse it in the next subject I'm going to be talking here. So to continue with that, there's another term you have to know. It's called aleatory contract. Insurance is also aleatory. If you're going to say it aleatory, that's up to you. Aleatory, that's up to you. You just need to know the word. Aleatory contract is an exchange of unequal values. The premiums amount paid is smaller than the amount of the insurer, the insurance company, will pay in the event of a loss. For example, a policy owner paid $100 a month. Oh, that's a month, okay? A month, the M for the month. So times 12 times 10 years. So if you do 100 times 12 times 10 years, the insured die after that 10 years. That's what I try to put in here. The insured die. So the beneficiary get $250, but therefore the client only paid $12,000 for the 10 years. So the $12,000, sorry. So that $12,000 will never equal the 250. So that's what that means. You pay a small amount for a big lump sum. What happened if the client, okay, if I could show you this, let's say, see, that's the way you do the math. So what happened if they didn't die in 10 years? What happened if they die in 2 years? So if it is 2 years, so that's 3 years times $1,200. So they only pay what? $3,600. So if they only pay $3,600, folks, think of it. If you only pay that, and for 250,000, so $3,600 will never equal 250,000. It's always going to be a different. So insurance are aleatory. Exchange of unequal value. You exchange 3,600, that's your value, and I give you 250. That's my value. So exchange of unequal value. You guys got it? I hope that makes sense. Oh, so you got to be willing to learn this material. It's awesome. It's unbelievable. You got to have fun with it. So let's go to another subject. So to continue with the unique aspect of insurance contract, we're going to talk about something else called unilateral contract. So what you need to also know about this one, when you see the word uni, okay, oops, I have to change my color of this marker here because you can't see this. Okay, let me make it green. Uni, it's been one. That's been one party legally bound to do anything. One party, which is the insurance company. The insurance company, one party, make that promise. That I promise you, if you pay me the premium, I will make sure that I pay you the death benefits. I promise you I'll pay the death benefits. That's why in chapter 3, later on, you're going to learn about insurance clause. Promise, you die, we pay. But also insurance contract are unilateral. So the insured makes no promise that you're going to pay the premium. So you guys never promise that, oh, I'm going to pay the premium. I promise you I'm going to pay you. But the insurer, which is the insurance company, legally bound to pay the losses covered by the policy. They promise they're going to do that. That's what unilateral contract means. One party make a promise, which is the insurance company. Moving along, right? You guys got that? So now let's continue to another topics here we're going to cover with you. The next topics here about the unique aspect of insurance contract now, it's going to be about conditional contract now. Insurance are conditional contract. That's means certain conditions must be met for the contract to be executed. So the insured must pay the premium. The insured must pay the premium. That's your condition. And make sure you didn't lie in the policy too. Make sure your statement are true. And you have to provide proof of loss of the death of the benefit paid. So you have to, you're not going to just call the insurance company, hey, my parent just passed away, or my mom just died, or my sister passed, or my cousin passed, or my friend just died. No, they need the proof, okay? Okay, you need to come with the proof that they passed away, the death certificate. So a conditional contract means if this happens, this will happen. Otherwise, it's a, if this does not happen, this will not happen. That's called conditional contract. If this happens, the word if is signal a condition. That's called conditional contract. So remember those four terms when it comes to insurance. Adhesion contract, take it or leave it basis. Aleatory contract, exchange of unequal value. Unilateral contract, one party make a promise, which is the insurance company, legally, you can make them pay. One party make, because you can take the insurance company to court to make sure they pay you, but the insurance company cannot take you to court because you don't pay your premium. So that's why it's a unilateral contract. One party make a promise, and at least conditional means certain conditions must be met. If this happens, this will happen. I hope that's helped. And if you like this video, thumbs up, share it, and you can subscribe and talk to somebody else about those things if that can help you in your insurance journey. Again, my name is Ernest. Welcome again to the MMC University. We're going to continue educate you to our journey. We are in this, I would say, together. All right. Have a good time, guys. I wish you success in the exam.